Good afternoon. Welcome to this webinar series on macro, finance, and emerging markets. This series is jointly sponsored by the Asia School of Business and the SEACEN Centre. My name is Eli Remolona, professor at the Asia School of Business. I will serve as your moderator along with Mangal Goswami, the head of SEACEN. We are privileged to have as our inaugural speaker Hyun Song Shin. He is economic advisor and head of research at the Bank for International Settlements. Hyun is an old friend going back to Princeton days, but I knew of him even before that, having been a big admirer of his work on coordination games, Keynesian beauty contests, and the social role of public information. When Prospect magazine named Hyun one of the world's 50 great thinkers, the magazine emphasized the wide range of Hyun's research, from big tech to inflation during the 30 Years' War, and the risk of contagion to macro-prudential regulation. Economics, it said, is overdue a paradigm shift so that finance is treated as fundamental rather than an afterthought. Shin is pointing the way. To me, he is the Richard Feynman of economics. As we all know, Feynman was a great physicist who won a Nobel Prize for quantum electrodynamics. He did his work not so much with math as with simple diagrams. As you will see, like Feynman, Hyun uses the simplest of diagrams to reveal the most profound of insights about the world. Today, Hyun will speak about original sin Redux. Hyun, welcome. Let me now turn over this webinar to you.
Well, thank you, Eli, and thank you, Mangal, for this very kind invitation, and thank you for that very generous introduction. It's a real pleasure to join you, albeit virtually. And the topic of the presentation today, I think, will be seen as being very current and indeed very topical. So, Eli, shall we move to the first slide?
Okay. Next, one more.
Actually, yes. So let's start with this this slide. This is, if you like, our benchmark case, and it's drawing attention to the distinction between a country's border, so the internal-external distinction in international finance, with the currency dimension, so one's own currency versus a foreign currency. So here's a case where the two distinctions do not matter, in that we have country A, here represented by the rectangle with a green boundary, and within that country are borrowers and investors who are represented here by the balance sheets. And the color of the balance sheet sides here represent the currency denomination. So here, the investors are lending to the borrowers through the bond market in country A's own currency. So here, the internal-external distinction and the own currency, foreign currency distinction do not matter. But if we click to the next slide, Eli, we can imagine that there is a borrower that's outside country A and would like to draw on the funds that are going to be provided by the investors in country A. And we can ask the question, what currency does that investment, in what currency does that investment take place? Now, in a very interesting paper by Maggiore, Neyman, and Schrager, what they document is that if the borrower is a is a private entity, so typically a corporate that issues corporate bonds, then the currency denomination of that investment tends to be in the lender's own currency. So let's flip to the next slide, Eli. What that means is if there is a borrower inside country A and is borrowing from a foreign investor, then if that borrower is a private borrower, then even though there is funding available inside country A, you would tend to borrow in the lender's own currency. So it holds symmetrically. And a good illustration is on the following page, which is a chart from the Maggiore et al. Paper. And here's a case of Canada and the internal, external, and currency distinction for Canadian corporate borrowers. So these are private borrowers, and we're going to see how the currency denomination dimension, which is on the horizontal axis, relates to the internal, external dimension, which is on the vertical axis. So on the horizontal axis, we are seeing to what extent the borrower is borrowing in foreign currency, which is measured on the horizontal axis. So if you're to the left at 0, you're borrowing entirely in Canadian dollars. If you're on the right-hand side, you're borrowing in foreign currency. On the vertical axis, this is indicating to what extent the investment is coming from within Canada. That's when the vertical axis shows 0, or whether the investment is coming from outside Canada, which is when the vertical axis is indicating 1. And each of these circles indicates the findings of the micro data that they have managed to assemble. They have some very good data that shows not only the currency denomination of the corporate bond, but also where the investor resides. So you can actually see whether the investment is coming from outside Canada, as well as in what currency that investment takes place. And what you see in this chart is that there is a bifurcation, if you like. The bottom left-hand corner and the top right-hand corner are the places on this chart which has the bulk of the observations. And to the extent that there are observations that combine internal, external, and foreign currency and domestic currency, they tend to lie on the 45-degree line, which is to say it is a convex combination of these two extreme cases. In other words, the bottom left-hand corner indicates those instances where Canadian firms are borrowing from Canadian investors, and the borrowing takes place in Canadian dollars. So if you borrow from domestic investors, you borrow in domestic currency. On the other hand, you have the observations on the top right-hand corner, which indicates that if you borrow from foreign investors, you tend to borrow in foreign currency. In other words, if you want to borrow if you want to borrow externally, if you want to borrow from foreign investors, you would tend to borrow in foreign currency. And this is an instance of what Eichengreen and Hausman called original sin in the context of emerging market borrowers. And this was a concept that was popularized after the Asian crisis, whereby the internal, external dimension corresponded very much with the currency dimension, in that if an emerging market borrower wanted to borrow from foreign investors, you would have to borrow in foreign currency, and thereby set in motion the various vulnerabilities that would lead to currency mismatches. And I think what this chart shows very well, and the work of Maggiore et al. Shows very well, is that for private sector borrowers, and that's a very important qualification, as you'll see. So for private sector borrowers, even for advanced economy private sector borrowers, original sin holds. But there's one exception, as Eli, we can see on the following slide, which is when the private sector borrower is a US resident and is borrowing in US dollars. So for a US resident corporate borrower, when you borrow from foreign investors, you would also tend to borrow in US dollars, and therefore in your domestic currency. And we see that in the following slide, Eli. In this, from the same paper, we see that for US corporate borrowers, we see that most of the observations are concentrated on the vertical axis, along the vertical axis, where very few of the US corporates are borrowing in foreign currency. So with the exception of US corporates, original sin holds in the case of private sector borrowers. Now, why might this be? And I think this is going to be very important for the rest of the presentation for emerging markets. So let's flip to the next slide. So remember that one of the important findings was that if a lender lends to a foreign borrower, then the lending takes place in the lender's currency. So that's one of the findings in the Maggiore et al. Paper. And I think one very persuasive argument would be that this is happening because the lenders, as investors, have also other obligations. And in particular, for institutional investors, such as pension funds, and in particular, life insurance companies who are much more present in fixed income markets, they have obligations to their policyholders in their domestic currency. So they have bond-like obligations, and therefore they try to meet those bond-like obligations by having assets that allow them to meet those obligations. And having currency risk would be an unnecessary additional risk factor for these institutional investors. And therefore, if possible, they would like to lend in their own currency. So for global investors, it would make sense, if you're investing in the bond market, to lend in your own currency in order that you can meet the obligations of your, your obligations to your domestic policyholders or to the beneficiaries. And typically, life insurance companies would have a much larger fixed income portfolio rather than pension funds, who are much larger, who have a much larger presence in the equity market. Now, before we get to emerging markets, Eli, let me just pause here to see whether there are any questions so far.
I have one question, Hyun. I was wondering, if you're borrowing in a foreign currency, especially if you're a private borrower, what do we know about your hedging behavior? Would you try to hedge the currency risk? What do we know about that?
Yes, we know quite a bit about that, and there've been various BIS publications that actually, Eli, you yourself have contributed to. What we know is that for corporate borrowers, if their cash flow is mainly in dollars, they would tend not to hedge. So if you're an oil company and your main export, your main sales are actually invoiced in US dollars, then borrowing in US dollars would actually make sense, because it is you're therefore hedging your main source of cash flows. What we have seen in the last few years, especially when the euro interest rates were actually quite a bit lower than dollar interest rates, we did see US corporates borrowing in euros and then using the FX swap market to swap those euros back into dollars. This has the label of reverse Yankees, because it is, if you like, turning on its head the traditional relationship where corporates would borrow in dollars and then possibly swap back into domestic currency. But I think in general for corporates, what we see is that when they borrow in dollars in the dollar corporate bond market, they would tend to keep the proceeds as US dollars. In some rare cases, what we also see is that they would borrow in dollars, but then convert the proceeds back into domestic currency, but leave the currency mismatch in place, so that that will be a kind of carry trade that is conducted by non-financial corporates in times when dollar liquidity conditions are very ample. And of course, that does set up currency mismatches, which would actually cause problems later on. So why don't we move on to the emerging markets, Eli?
Yes. Okay.
Now, one thing that I don't have to remind the audience on in this webinar is the lessons from the 1990s emerging market financial crises. I think one of the key lessons that was learned during the Asian financial crisis in particular, but also the other EME crises in the 1990s, was that emerging markets should avoid this combination of a currency mismatch and a maturity mismatch. So a currency mismatch would arise if the borrower borrows in dollars, but then has unhedged dollar liabilities while the cash flows are in domestic currency. And equally important is the lesson that borrowers should avoid maturity mismatch, in that if you borrow short term, a retreat of financial conditions, a reversal of financial conditions would manifest itself in terms of a sudden stop or a run, rather than simply a decrease in the flow. So if the combination of a currency mismatch and a maturity mismatch is the main lesson, then of course the best way of overcoming both would be to borrow in your domestic currency and borrow long term. And in fact, if we flip to the next slide, this is in fact exactly what emerging market sovereign borrowers have been able to do. So at least for the sovereign bond issuance from emerging markets sovereigns have well and truly overcome original sin. And we can see it from this chart, which shows the proportion of the local currency sovereign bonds that are in the hands of non-resident investors. We see a very wide range, but for some of the large emerging market borrowers, it is close to or even above 40%. And I will show you another chart later, which will give you a better sense of the time series as to when exactly this increase happened. But the biggest increase happened at the time of just in the period after the global financial crisis, when we saw a big growth in the fixed income market, both in advanced and in emerging market economies. So let's flip to the next slide. So I would like to spend now a few minutes on what looks like a fairly technical point, but I think it's going to be a very important point for the rest of the presentation. So let me take a few minutes here. Now, the backdrop is very much the idea of original sin and the fact that now sovereign borrowers in emerging markets are now managing to borrow in domestic currency and in fairly long maturities. So typically they would be 5 to 7 years, as you'll see with some of the private sector bond indices. The issue, though, is that once the borrower has overcome original sin, the focus then moves to the investors. So what is really motivating the investors? What Augustin Carstens and I have put forward is the idea that original sin may still be there, but in a slightly different guise. So in the sense that although the borrowers have managed to overcome currency mismatch and maturity mismatch, the investors may be holding some currency mismatch on their balance sheet. Now, typically, when investors from advanced economies invest in other advanced economy sovereign bonds, that is typically done on a hedged basis. That's to say, when, let's say, a life insurance company in the euro area invests in US fixed income instruments in US dollars, then that's done on a hedged basis, in that first you swap euros into US dollars, and then it invests the proceeds in the US dollar fixed income instrument. However, when global investors come to emerging markets, they would enter the market typically on an unhedged basis. In other words, they would come and they would invest in the domestic currency, even though the investors' obligations to their domestic policyholders would be in their domestic currency. And I think it's very important to understand for us why they do that. And the next few slides will give you a sense of why they might enter emerging markets on an unhedged basis. So let me explain that. Let's go back, Eli. I want to just explain the notion of duration. The duration is so one way of defining duration is the sensitivity of the return, the mark-to-market return on holding a bond to changes in the yield of that bond. Because the price and the yield, they would have a negative relationship, we typically put a minus sign in front so that it gives us a sense of the that we can convert it into a positive number. The formal definition of duration is as a weighted average of the maturity of the cash flows from holding the bond. So formally, the duration is defined as the weighted average of the dates when a cash flow materializes, where the weights correspond to the proportion of the present value from holding that bond that is realized in that period. So if it's a zero coupon bond where there are no coupons, then you simply get a return of the principal at the end of the maturity of the bond. So then all the payoff happens at the end, and therefore the duration and the maturity are the same things. So the duration of a zero coupon 5-year bond would be 5 years. But typically, if you have coupons, some of the cash flows would happen earlier, and you would have a duration which is slightly less than the maturity. But since the principal is much larger than the coupon, the duration would be roughly equal to the maturity of the bond. Now, the key distinction here is whether we measure the returns in local currency terms, or whether we measure the returns in dollar terms. So it's a numerator of this duration calculation. So if we move to the next slide, we can approach the measurement of duration as, well, we can do it in a purely mathematical way, but also another way of doing it would be to try and see how the returns co-vary with the yield changes. And typically, because the price would fall when the yield rises and vice versa, we would see the observations over time happening either on the top left-hand corner when the yield falls, or on the bottom right-hand corner when the yield rises. And the slope of that relationship would give us a measure of the duration with a minus sign in front, because that's the relationship between the percentage return and the yield change. And the crucial distinction here is whether we measure the percentage return in dollar terms or whether we measure the percentage return in local currency terms. So Eli, if we flip one more slide.
Can you see?
So let me illustrate this. Yes, I can see it now. So let me illustrate this for a period before the recent turbulence in financial markets. And here I've picked Mexico and South Africa to illustrate how the dollar duration and the local currency duration are actually very different. So the blue dots here correspond to the relationship in local currency terms. So here on the left-hand panel, I've given you the case for Mexico. And what I'm plotting here is the weekly change in the JP Morgan EM Principal Return Index. So this is an index that typically has bonds that are maturity of between 5 and 7 years. And therefore, we would expect the duration to be somewhat less than 7. And here we see that the blue line, which gives the relationship between yield changes and Mexican peso returns, the slope of that relationship is 5.05. So for every percentage point increase in the yield, you have a negative return of 5%. That's that is the meaning of that relationship. But the red dots give you the same relationship, but in US dollar terms. And you see that the red scatter chart gives you a much steeper relationship. If you look at the slope is 12.4. It's minus 12.4. In other words, if you're a dollar-based investor who evaluates returns in US dollar terms, the duration of your Mexican bond holdings, which are of maturity between 5 and 7 years, is over 12. In other words, it's like holding a much longer maturity bond, say a 15-year bond. And therefore, you're facing a much larger fluctuation in the value of the bond to the same yield increase and decrease. I think this is really key to understand what might be motivating the global investor here, because if you look at the left-hand part of that panel, what we're seeing is those states of the world when the Mexican 5-year yield has decreased. So these are states of the world when financial conditions are very accommodative. And this would be typically periods when there are capital inflows, the growth is very strong, and this is what finance professionals would call the risk-on periods. So during the risk-on periods, the dollar-based investor earns a higher return than a local currency-based investor. And the reason is that the dollar is depreciating against the peso in these states of the world. So if you're a dollar-based investor, you are not only seeing an increase in the peso price of the bond, you're also seeing an appreciation of the Mexican peso vis-a-vis the dollar. And therefore, you gain both on the capital gains on the bond, as well as on the currency appreciation of the Mexican peso. However, when financial conditions turn, and we're on the right-hand side of this panel, these are the states of the world when the yields are increasing. And you can see that the red dots are below the blue dots, which is to say the US dollar investor is facing a larger loss compared to the local currency-based investor. And of course, this is because not only are you seeing a capital loss on the bond holdings, you're also seeing a currency depreciation of the Mexican peso. And therefore, you're losing both on the bond and also on the currency. And so what this chart shows very clearly is that if you're an unhedged investor, your gains and losses are amplified if you're borrowing unhedged in an emerging market local currency sovereign bond, to the extent that it's as if you're investing in a 15-year bond, as opposed to what is in truth a 5 to 7 year bond. The right-hand panel is the case for South Africa, and you see exactly the same relationship, where in local currency terms, the duration is 4.59, but in dollar terms, the duration is 12.8. And so you see this very much larger amplification of both the gains and losses. So I think what this shows is very clearly that if you're coming in on an unhedged basis, you're typically an investor that is going to take advantage of this pro-cyclical nature of the returns in US dollar terms. So you will gain a lot more during periods when financial conditions are very accommodative. And hopefully you'll be out of this particular market before you realize all the losses when the currency depreciates. Let's move to the next slide, which gives two more examples.
Sorry, Hyun, it's not responding. But...
Maybe you can just reset. You can press escape and...
Stop sharing for a second and then come back.
Mm-hmm.
There we go.
Let me change this.
Let's move to the next slide.
Without sharing it.
Mm-hmm.
We haven't perfected the virtual thing yet.
I think this is...
I think it's when...
Eli, you had it up. Yeah, you have it. You have it.
Excellent. Good.
The
previous one. It's the previous one, Eli.
Yes, okay.
It's the previous slide. Yes. So here are two other examples. One is, one is from Asia, Indonesia, and also from Brazil. No need to spend too much time on these ones because it's showing the same relationship. So let's move to the next slide, Eli. And the next slide is just to show you that what I've illustrated for emerging markets is not a mechanical relationship. And I will do that by showing the case for two advanced economies where that relationship does not hold. So here we have France and Sweden. And here you see that the red dots are all over the place. In fact, there is really no a very strong relationship. And indeed, the blue line is steeper than the red line. So what I've shown you for the the emerging market economies does not hold for the advanced economies, in that for the advanced economies, we see that the dollar returns are really very noisy. And what this suggests is that the exchange rate and financial conditions move pretty much independently. And for that reason, we see that the dollar duration and the local currency duration typically have no strong relationship. And this is a very good way to illustrate the fact that for advanced economies, when external investors enter the market, they would typically do it on a hedged basis. So when they enter, they would enter with the currency risk hedged, typically through the swap market. But it's not the case for emerging markets. For emerging markets, the lesson is very much that exchange rates have very much a financial conditions component, in that exchange rate depreciation is associated with tightening financial conditions and steepening yield curves. And this creates a big dilemma for monetary policy, in that when your exchange rate is depreciating, this tends to coincide with tighter financial conditions and slowing domestic activity. So in view of the domestic activity, you would like to lower interest rates. But due to the capital outflows and the currency depreciation and the associated currency feedback, you would like to raise interest rates. So that presents a dilemma. Typically also, when your currency is appreciating, that coincides with a very strong currency. And so domestic activity is very strong. So you would like to moderate the overheating, especially in the credit market. But the exchange rate consideration and pass-through into domestic inflation would dictate cutting interest rates. So it is always a dilemma in that respect. And we can discuss later what the policy response might be. But let me just pause there, Eli, to see if there are any other questions.
I think Mangal has a couple of questions.
Yes, Hyun, thank you very much. Again, from where I come from in the IMF, your papers are widely read along the corridors of where I come from, the Monetary and Capital Markets Department. So it's a lot of great work you do. So thank you again for coming on here. Very quickly, I wanted to ask you about you already talked about the risk transfer to the investors in the emerging market world, where clearly that leads to other challenges like the amplification in the macro financial between the exchange rate and the financial conditions. And you say that the part of this can be attributed to the lack of hedging in currency risk in emerging markets. Is it also possible to think about that, emerging market investor base, foreign investor base is quite a wide spectrum, right? This asset class has, investors who also invest opportunistically if there is lower hedging cost. For example, crossover investors who indulge in carry trades may sometimes actually invest and then hedge in the non-deliverable forward market or an offshore market of similar derivatives. Yeah. Then there are like your index-based investors, notably ones like the pension funds who may have a mandate to actually seek some kind of, not be exposed, but be hedged on their FX risk. So these are some of the things. Of course, for your levered investors like hedge funds, they clearly are in the business of getting both the currency and the returns and the yield component. How does all of this sort of, does it at all change the analysis at all? And also, I was just curious, these returns, when you extract them, are they risk-adjusted returns or they're just regular returns from the index?
Yeah. So Mangal, let me start with your last question. These are just the raw returns. And of course, we can do the decomposition, and later I can point you to some papers that are referred, and I can point you to the references of our BIS Bulletin number 5, which will have all the relevant references. But you've raised a very important point, which is what do we know about the investor universe and how we keep track of in how those investor proportions change with respect to the destination. The short answer is we know something about the investor base, but it's a very incomplete picture. For example, in the Maggiore et al. Paper, they have very detailed data, but it's limited to the mutual fund universe. So we have very detailed data, but for a very small subcomponent of the investor base. We do have some data from the IMF, the survey data, the CPIF data on the cross-border fixed income, but even there, they're on an it's limited by how aggregate the numbers are, and also by the fact that it's measured on an immediate counterparty basis. So, for example, if the investment firm is a resident of an offshore financial center, then the data would show a claim of that offshore jurisdiction rather than the ultimate beneficial owners. And I think what this points to is a bit of a data gap between the very detailed data that we have on the regulated financial institutions and the data that we have for the non-regulated, or at least those firms that are regulated not on a macro systemic basis, but rather on consumer protection, on a consumer protection mandate. And so there is still some work to be done. Now, if you're creative, you can, of course, bring together different pieces and then reconstruct the jigsaw puzzle. And so Eli and his colleagues, when he was here at the BIS, he was really one of the masters at doing this. And we, of course, have still other pieces of work that, for example, piece together the banking sector holdings by piecing together the banking statistics together with the OTC derivatives statistics, so that we can get a good aggregate picture. And I would point you to, I would point the audience to BIS Bulletin number 1, which was the first of the BIS bulletins that we published, that we launched a few weeks back. It gives you a very good sense of the currency pairs in the OTC derivative sector, so that you get a sense of where the investors are coming from. But those are very indirect inferences. And I think the larger question that we have to ponder is, what is the perception of the investors when they enter an emerging market, fixed income market? I think there is still a perception, and you can see it in all the investment bank notes, all the research notes that come to the so-called buy side, that still there is a sense that emerging markets are still where you would venture into if your risk appetite is sufficiently high. So you would first enter your domestic market, and then you may enter a advanced economy fixed income market, but you would do it on a hedged basis to pick up the yield by rolling over short-term FX hedges. And if on top of that you have the additional risk appetite, then you would venture into some of the riskier investments. But I think emerging market fixed income is still very much regarded in that category, that you would enter if you have the risk appetite to enter. Now, why would you not hedge when you go in? Well, I think one of the reasons is that the hedging cost depends very much on the slope of the yield curve, because what you would do is you would roll over short-term FX swaps. So even if you invest in a 5-year bond, you would roll over 3-month FX swaps. And if the short-term interest rate in the emerging market is very high, your hedging cost is not very cheap. So you would actually, rather than picking up the higher yield, you are losing most of the advantage by, through the hedging cost. So, for example, if an emerging market has a 5-year yield of 10%, but the short-term rate is 9%, then as a first approximation, the hedged yield is only 1%. And so you would not do, so you would typically not enter on a hedged basis. And in any case, the hedging market is very thin anyway. You could do it through non-deliverable forwards, as you suggested, and there will be a market there. But typically, non-deliverable forwards you would use as an ex-post hedging device. In other words, you would enter on an unhedged basis, and when the tide turns and the market becomes very stressed, it's difficult to exit at that point because the bond market tends to be quite illiquid. However, because the currency market and the bond market tends to be highly correlated, you can hedge yourself, you can extricate yourself at least partially by selling the domestic currency. So rather than selling the bond, you would actually buy dollars and sell the domestic currency ex post. Unfortunately, that is exactly the wrong time as far as the domestic borrower is concerned, because then you're adding to the currency stress. I think this is something that we've seen also in the recent episode, and we can pick this up again as to what the central bank should be doing precisely at that point. But I think that's a kind of a long answer to your question, Mangal.
Thank you so much, Hyun. I think in the interest of time, there are some policy questions. I think that's more relevant from the audience for the next part that you, so yes. Shall we, Eli, if you please, yes. Over to you.
Let's move ahead. What I want to do in the remaining time is to just give you an update on what actually happened during the COVID-19 financial stress, especially in the second half of March. This was published about 6 weeks ago, BI's Bulletin number 5, with my colleagues Boris Hoffman and Eli Shin. So if we flip to the next slide, Eli. And what we see is that, indeed, if we look at the bond fund flows from the mutual fund inflow and outflow data, we do see that in March, we saw very rapid and very sharp fund outflows from emerging market bond funds. And on the right-hand panel, we see exactly this correlation between the exchange rate and the domestic financial conditions. So the red line is the bilateral dollar exchange rate, and on the right-hand side is the bond spread. And we see that they move in lockstep. Now, so this is very much a repeat of the previous relationships, but it's happening with a vengeance, if you like, because you see that the increase in the bond spreads were extremely steep. If we flip to the next slide, Eli. The left-hand panel gives you a sense of the external investor participation when we classify emerging market sovereign bond markets into Asian EMEs and other EMEs. And you see that before the great financial crisis, the foreign participation in Asia was quite low. But we see that after the GFC, we saw that increasing. It's still lower in Asia than in other EMEs. But if we look at the right-hand panel, we see that on the vertical axis, we're seeing the increase in the local currency bond yields over the period in question. And on the horizontal axis, we're measuring the proportion of the sovereign bond market in the hands of external investors. And there are countries like Korea, India, where the foreign participation is pretty low. As we move to the right-hand side, where foreign participation is higher, we see that the increase in yield has been higher. So there is this upward sloping relationship. So the more your market is reliant on external investors, the larger is the impact of foreign investor exit. If we move to the next slide. The next slide is showing that indeed the relationship that we had documented for emerging markets between the local currency duration and the dollar duration also asserted itself quite strongly this time around. So right-hand panel is for the period in March, which shows that the steeper relationship in the dollar duration exerted itself again. So very much playing out in the way that we would have expected. Next slide. And now, interestingly, what we see is that even for the advanced economies, we see that the red line is steeper than the blue line. So in fact, I think what I would take from this is that some of the forces that were impacting emerging economies were also felt to some extent in the advanced economies as well. So it, I think, attests to the severity of the stresses that we saw in the bond market. Next slide. So next slide are some charts that we discussed in the special chapter of our annual economic report from last year, which was on emerging market economy monetary policy frameworks. The left-hand panel is an updated version of this, which again illustrates this very sharp negative relationship between the spreads on emerging market sovereign bonds and the exchange rate. So when your currency depreciates, the spread widens. The right-hand panel is a time series, a plot, which shows that in fact, if we do a proper time series exercise and plot the impulse response of the impact of an exchange rate depreciation, we also see a fairly persistent impact both on the spreads, which is in red, and also on the risk premium, which is in the which is in the gray and the black. Next slide. And I think the so these are some charts that we also discussed in the annual economic report. The lesson that we draw from the annual economic report from last year for the monetary policy framework for emerging markets is that FX reserves, those countries that have large FX reserves, tend to fare better during periods of financial market turbulence. And I think one very important lesson here is because the exchange rate is entering into the dynamics, even if the country were to have no currency mismatches, because of the original SEACEN Redux dynamics, which happens through the investor balance sheet, it is very important to factor into account the impact of the exchange rate. So FX reserves would be very useful to cushion domestic financial conditions, even if the domestic financial sector did not have currency mismatches. And I think this also shows why the extension of the Federal Reserve's FX swap arrangements with central banks, as well as the new repo, the Treasury repo facility, the FEMA facility, has been very effective in bringing some of these spreads down. So let me conclude with the last slide, Eli. So I would refer everyone to our chapter in the BIS annual economic report of last year. What we do in this chapter is to, in a way, anticipate many of the issues that we've discussed today. And we lay out a policy framework, a monetary policy framework, which takes account of the exchange rate dimension. And I think, as this graphic shows, the monetary policy framework for emerging market economies is really at the frontier of the subject. And this is one area where the practice has outrun the theory, in that many of the prescriptions that we lay out are already being practiced by many emerging market central banks. And we end with the conclusion that the theory has to catch up with the practice. And we have been working very hard at the BIS to lay some of the foundations for the theory as well. So let me conclude there, Eli, and I'd be happy to take some questions at the end.
There's some good questions from the floor, Hyun. It's one of them is related to this theory and practice cycle. You mentioned how exchange reserves have been useful. Countries with a lot of exchange reserves tended to fare better. What about the role of, say, macroprudential measures, which I guess is one of the practices that have become common among emerging markets? And then the accumulation of reserves is presumably related to foreign exchange intervention, which also has become common among emerging markets. So how do these things figure into the original sin Redux?
That's a very good question. And perhaps I could start with mentioning that the IMF is also very active in this area. And as we know, the IMF has been working on the integrated policy framework, which is integrating monetary policy, macroprudential frameworks, and FX intervention. And I think the rationale there is very much consistent with what we've been speaking here. The macroprudential frameworks will give you a degree of freedom in your policy framework, in that when you have a policy dilemma between higher interest rates and lower interest rates, for example, when your currency is appreciating very sharply, and this coincides with a credit boom in your domestic economy, monetary policy typically will be pushed in two different directions. Whereas if you have an extra policy lever in terms of macroprudential frameworks to lean against credit booms, that would be another way of dealing with a credit boom. And typically when your currency is appreciating very strongly, this is also a period of very rapid capital inflows. And therefore a policy of leaning against the wind and accumulating reserves during periods of very accommodative financial conditions will serve both the purpose of leaning against the very accommodative credit conditions, as well as to build up your FX reserves at that point. So I think when I mention the need for an integrated theory on this, I think this is very much the frontier at the moment, to combine monetary policy with macroprudential frameworks combined with FX intervention.
I don't think we have time for another question. It's 3:59, and we had promised that we'll let you go at 4 o'clock because you have another meeting to join soon after. Is that, Hyun, is that, should we?
Yes, I think, yes. And then we can, of course, if you watch what we are putting out, that would be a best way of keeping in touch. And, we would, of course, be very happy to receive feedback from you. So thank you, Mangal, and thank you, Eli, for hosting this webinar. It's been a pleasure to join you, albeit virtually.
Thank you, Hyun, very much. Hope you can join us again, virtually or physically.
Yes, yes.
Very good. Thank you, Mangal. Okay. Goodbye, everyone.
We have some housekeeping announcements. While Hyun is leaving, we have some housekeeping announcements very quickly. On behalf of the SEACEN Centre and Asia Business School, we would like to thank all the participants for joining this. Please do go in and complete the survey. There are only 2 questions your main takeaway and suggestions for future programs. Please do take the survey as soon as possible before you forget. And we would like to make some announcements on future programs coming up, both for the SEACEN Centre and ASB, and there will be some events, notably a joint event coming up. This is on the 3rd of June with Marcus Brunemeyer from Princeton. This is a joint Asia School of Business and SEACEN event on comparing COVID-19, this episode versus the previous GFC. So that's upcoming. If you look at the SEACEN website, you'll see many others coming up. Matthias Trebond from Berlin is going to join 18th May, 30th May, Sebastian Edwards from UCLA, Stephen Socchetti, Brandeis, 8th June, so on, Anat Admati, so on and so forth. So again, we had over 190 participants initially today. So I hand it back over to Eli for the final vote of thanks.
Let me thank Anela Monroe, who helped a lot with this webinar. Oli Rommel, who also helped a lot. Anela is with the ASB and Oli.
And Ozer.
And Ozer Kadegli is with the SEACEN Centre. Thank you very much. See you at the next one.